Welcome to the deep dive. Today we're focusing on China Shenhua Energy Company Limited.
Right, the Beijing-based giant. Established back in 2004, listed in Hong Kong, then Shanghai.
Exactly. Known primarily for coal and electricity, but their reach is, well, much wider. They've got railways, ports, shipping.
And even called olefins. It's
Yeah.
that whole integrated model that's really key here,
That's it. Production, transport, conversion, they manage the whole chain.
which, theoretically gives them big advantages.
Yeah.
Efficiency, stability, maybe lower costs.
So that's what we're digging into today, their 2024 performance based on their annual report. We want to look at the business segments, the financials, shareholder value plans, and the outlook.
Yeah, and just a quick note, as always with these reports, there are forward-looking statements. They involve assumptions, risks, so things might pan out differently. Standard stuff, but worth mentioning.
Absolutely. Okay, let's jump right in. Where should we start? Maybe the core, the coal segment.
Sounds good. So in 2024, they produced 327.1 million tons of commercial coal.
And sales.
Sales volume was actually up slightly, 2.1% year on year, hitting 459.3 million tons.
Okay, and who's buying all this coal?
Well, it's interesting. Their top 5 external customers account for nearly 42% of sales.
Wow, that's quite concentrated.
It is. And the single biggest customer, China Energy Group, they took about 165 million tons. That's almost 36% of total sales.
36% to one customer. That's something to keep an eye on.
Definitely a concentration risk, yeah. Though likely a stable relationship, too.
So how do they balance what they dig up themselves versus what they buy in to meet that kind of demand?
Their strategy is basically coordinating the two. They're actively increasing the amount of coal they purchase externally.
To ensure supply for the whole integrated system.
Exactly. It smooths things out. Plus, they focus on, customized coal production for specific needs and optimizing their pricing, trying to handle those market swings.
Makes sense. What about investment in coal? What are they spending?
The plan for 2025 is RMB 9.681 billion in capital expenditure for coal. Interestingly, they actually spent more in 2024, RMB 12.587 billion.
And that doesn't include buying mining rights.
Correct, that's separate. They've also got key projects moving forward, like the Xinji number 1 and 2 mines and the Turingella mine via the Hanjin Energy acquisition, adding quite a bit of capacity there.
You mentioned market swings. That volatility must be a constant challenge.
Oh, absolutely. The report mentions it directly. They say they're continually working to improve how they cope with those fluctuations, pricing, planning, all that.
Okay, so a lot of that coal feeds their own power plants, right? Let's talk about the power segment's performance in 2024.
Right. Total power output dispatched was 210.28 billion kilowatt-hour. That's up 5.3% year on year. A decent jump.
And how much of that is sold on the open market?
A huge chunk. 97.6% was through market-based trading. Very high.
But I saw the price dipped slightly.
It did, yeah. The average selling price fell about 2.7%, down to RMB 403 per MWH from RMB 414 in 2023.
Any cushion against that?
Yes, they received around RMB 5 billion in capacity tariffs in 2024, which definitely helped offset that price drop. Still, that downward price trend is something to watch. Suggests competition, maybe.
Possibly. What's their total generating capacity now?
End of 2024, they had 46,264 milliW installed. The vast majority of that, over 43,000 milliW, is still coal-fired units.
Are they expanding? Building new plants?
They are. Projects like Guangdong Qingwen Phase 2 and Shaanxi Jijiang Phase 2 are under construction, both large 1,000 milliW unit projects.
And strategically, what's the focus for power generation moving forward? More coal or a shift?
The focus is definitely on cleaner, more efficient thermal power, and also promoting the sort of low-carbon transformation of their existing coal power fleet.
So investing heavily there.
Seems like it.
Sure.
The planned CapEx for power in 2025 is RMB 17.411 billion, which is actually up from the 13 billion they spent in 2024. Significant investment.
Okay, let's move to the transportation segments. Railway, ports, shipping. How do they do?
Well, the railway network is extensive. Over 2,400 kilometers operating mileage. They moved a massive amount, 312.1 billion ton kilometers in 2024.
Ton kilometers. That's weight times distance, right?
Exactly. A key metric showing activity. Now, the ports handled more loading volume, which is positive, but the gross profit margin decreased. So more activity, but maybe higher costs or pricing pressure squeezing margins there. The report doesn't spell out why exactly.
Interesting. And shipping.
Shipping's a bit different. Shipment turnover was down because of a business structure adjustment, but the average shipping price went up. So overall, their gross profit margin actually improved in shipping.
So what's the big picture strategy for transportation?
It's all about optimizing the network, integrating their dedicated lines, connection lines, and really developing large-scale logistics, making it all work together seamlessly.
And the investment reflects that.
Yeah, planned capex for transport in 2025 is RMB 8.166 billion, up a bit from the 6.7 billion spent in 2024. Continued focus on improving that infrastructure.
Okay, one more segment, coal chemicals. Seems smaller, but what's the plan there?
The emphasis is shifting towards higher value-added products. Think coal-based new materials. They want a more high-end, diverse, and importantly, lower carbon chemical business.
Lower carbon from coal chemicals. That sounds challenging.
It definitely is, but that's the stated goal. And the planned investment jump is significant. RMB 5.446 billion planned for 2025 compared to less than 700 million spent in 2024. Suggests a real push in this area.
You also mentioned they're expanding the whole integrated framework and using lean management.
Right. They got approvals for those big mining projects, the Dongji Railway, port expansions, plus the Hangjin Energy acquisition.
Yeah.
All about strengthening that vertical integration. And lean management is, the continuous improvement drive across all segments, quality, efficiency, cost cutting.
Okay, that gives us a good feel for the operations. Let's zoom out and look at the key financial highlights for 2024. How did the numbers stack up overall?
Overall revenue was RMB 338.375 billion. That was actually down slightly 1.4% compared to 2023.
Why the dip?
Mainly due to market prices for coal and power fluctuating, according to the report.
And what about the cost side? Did costs go down too?
No, actually. Cost of sales went up slightly by 1.7% to RMB 236.555 billion.
What drove that increase if revenue was slightly down?
It's a mixed bag. The cost of purchased coal actually decreased, which is good.
Yeah.
But personnel expenses jumped quite a bit, 16.5%. Transportation charges were also up 5%. On the plus side, repair and maintenance costs dropped significantly, down 17.5%.
So revenue slightly down, costs slightly up. How did that impact the bottom line, profitability?
Profit attributable to equity holders held up quite well, actually. Came in at RMB 62.421 billion.
And earnings per share?
That translates to RMB 3.142 per share. Pretty solid. Their balance sheet looks healthy too, gearing ratio at 23.3%, and a total market value hitting RMB 822.1 billion at year-end.
Let's talk cash flow. Always tells a story. Operations.
Net cash from operating activities was strong. RMB 93.348 billion, and that was up 4.1% year-on-year. So the core business is generating more cash.
Okay, good. Investing activities.
That's where you see a big change. A huge outflow net cash used in investing was RMB 85.359 billion.
Wow, that's way up from the year before.
Not massively up. It was only about RMB 37 billion outflow in 2023. The main reason. Big increases in buying time deposits and structured deposit products. Parking cash, basically.
Interesting. And financing activities, paying down debt, dividends.
Also an outflow. Net cash used in financing was RMB 51.173 billion. So, yes, likely reflects dividend payments and maybe some debt management.
Can we get a sense of their free cash flow then? Operating cash minus capex.
Yeah, roughly. If you take the operating cash flow of RMB 93.3 billion and subtract the total capex they completed in 2024, which the report sums up elsewhere as around RMB 12.7 billion, you get a free cash flow figure to the ballpark of RMB 80.6 billion. Still very substantial.
Okay. The report also mentioned higher interest income. How come?
But they put it down to better financial market research and basically optimizing where they put their cash more into things like large CDs and structured deposits that likely offered better returns.
Right. Shifting gears now, let's talk shareholder value, crucial for investors. What's China Shenhua doing on that front?
They highlighted their 11257 market value management system. The report doesn't detail exactly what a 15257 entails, but it's their framework. And importantly, it includes a clear cash dividend policy.
Okay, what has that policy been?
For the period 2022 to 2024, they committed to paying out no less than 60% of their net profit attributable to shareholders as cash dividends each year.
60%? That's pretty generous. Are they sticking with that?
Actually, they're proposing to increase it. For 2025 through 2027, the proposal is an annual cash dividend of no less than 65% of net profit attributable to equity holders.
65%, wow.
Yeah, and they're also floating the idea of potentially doing interim dividends during that period, more frequent payouts.
But that's still just a proposal for now.
Correct. It needs shareholder approval at the annual general meeting, which is scheduled for June 17th, 2025.
Okay. Any word on when the 2024 final dividend might actually land in shareholders' accounts?
The preliminary timeline suggests around August 20th, 2025 for the H shareholders. The report also goes into the details on withholding tax rates for different shareholder types, like H shareholders versus mainland investors via Stock Connect.
Right, the usual tax considerations. Did they do any share buybacks in 2024?
No, the report explicitly states no share buybacks occurred in 2024. The focus seems squarely on the cash dividend.
So dividends are clearly a priority.
It certainly looks that way. They also point to their consistent grade A rating for information disclosure from the Shanghai Stock Exchange, 11 years running. And they highlight that their total market cap has grown for 4 straight years, building that investor confidence.
Okay, let's wrap up by assessing the business moving forward. Based on the report, what's the outlook? Key priorities, challenges.
Well, they reiterate their commitment to China's big energy strategies,
Mm.
the 4 revolutions in one cooperation, carbon peaking, carbon neutrality goals. That's the backdrop.
And operationally.
The core focus remains on leveraging that integrated model to ensure stable energy supply. That's job number 1.
What specific initiatives are they pushing?
Quite a few mentioned. Intensifying coal resource acquisition, so still securing coal supply, but also focusing on cleaner, more efficient coal development and use. Big push on energy efficiency across the board.
And in power.
Continuing to build efficient thermal plants, but also really driving that low-carbon transformation for existing coal power. Plus, optimizing transport, developing those higher-value coal chemicals we talked about.
Any movement on renewables?
Yes, they mentioned prudently advancing wind and solar power, and also exploring what they call strategic emerging industries, energy storage, hydrogen, even biomass energy, so dipping their toes into newer areas.
But the report also included a risk warning about hitting 2025 targets.
It did, a material risk alert. They caution that achieving those targets isn't guaranteed due to, well, uncertainties. Things like supply and demand shifts in coal and power markets, potential policy changes, the usual suspects in this industry.
Plus other risks.
Yeah, the director's report section details others: safety, environment, compliance, competition, international operations risks. Standard for a company this size, but important context. Their planned CapEx for 2025, about RMB 41.8 billion across all segments, shows they're still investing heavily despite these risks.
And governance seems solid.
They highlight the re-election of the board and supervisory committee, completing a 3-year quality improvement plan. And they mentioned establishing that market value management group, linking it to this steady market cap increase in 2024.
Okay, so to quickly recap our deep dive, we've looked at China Shenhua's 2024 through its business segments: coal, power, transport, chemicals. We dug into the financials, saw revenue slightly down, but strong profits and cash flow, albeit with huge cash parked in deposits. We examined their shareholder return plans, notably the proposed dividend increase. And we considered the future path, balancing traditional energy with new initiatives amid market uncertainties.
Absolutely. That integrated model is clearly their anchor. But they're navigating this complex energy transition, trying to optimize the old while carefully exploring the new, all while keeping shareholders happy with those significant dividends.
Which leads to a final thought for you listening. In this shifting energy world, with pressure for decarbonization, how well-positioned is a giant like Shenhua, so rooted in coal but also making these moves towards cleaner energy and efficiency? Can they successfully manage that transition while still delivering the kind of shareholder value investors have come to expect? What would be the key signs you'd look for to track their long-term success?
Something to ponder.
Indeed. Thanks for joining us on the Deep Dive.